are 55 or older, this show is for you. Welcome on in to Lowcountry Money Talk. We've got Phil Bloyd with Revolutionary Financial Group at the desk with us, helping us navigate retirement. Thanks so much for coming in.
Glad to be here, Jessa.
We have a lot to discuss on today's show. I do say that every time, but it's always true.
Sure.
It's always true.
There's a lot out there.
Now, one of the things we like to do on Lowcountry Money Talk is help kind of do some myth busting. Today, we're gonna walk you through the top 10 mistakes that you can make in the complex world of individual retirement accounts. So this is important because we're gonna give you some valuable insights to really help you navigate and build a solid foundation for your financial future. So Phil, kick us off here. Why is this such an important topic?
Well, because almost everyone has these type plans or 401ks or something related to that. They can be complex, but we want to follow KISS.
Not the band.
Not today, but I'm saying we want to keep it simple. I don't want to say stupid, but silly.
Right.
Okay, you said Sally, we'll say silly.
I said I like
okay.
Sally, but silly's
so,
good too.
You know, if we get too complex, you know, we miss things or whatever. So the idea would be, first of all, the reason that they become so complex is because there's so many regulations. And when we bring in, you know, the IRS and taxing and ages for distribution and what happens to beneficiaries and how they take the money out, it can become very complex.
Right, it can, and there's differences that we need to keep in mind, and there's different ways of kind of navigating these products. So walk us back through the difference between a Roth IRA and a traditional IRA, and then for people out there who are still working and if they do have an employer match.
Yeah, okay, so the importance of IRAs are, you know, these are probably for most people their single largest saving mechanism. Because, you know, if you don't see it, you don't miss it. Yeah. So maybe it comes out of your check, you know, and you're like, oh, you know, so we don't know how much we're paying in taxes because it comes out of our check, or we don't pay attention to it. We don't pay attention to our FICA, our Social Security, our Medicare deductions. We're just like, okay, this is the check I get. Right. So a great way for people to save that normally, you know, if they had to write out a check and deposit in a bank, maybe they don't save as much. So they're important in that sense. The other importance is that your employer, for a lot of people, will match a certain percentage. So it always blows me away, Jessa, when, you know, I'm talking to people, I'm like, how much are you putting for 401k? And they're like, well, I'm not contributing. I'm like, well, what's your employer's match? And they may say 3%, 5%, whatever. And I'm like, you realize that's free money.
Totally free money that you could be getting.
Because your employer's going to put in a certain amount based upon how much you put in. So if you put nothing more in, at least put in the match.
At least just the match, to get that free money.
Right. So now let's talk about the difference, like you asked about 401ks, Roth compared to traditional. So on the traditional 401k, they're taking the deduction pre-tax. Right. So for example, if I were contributing $10,000 and a year and my tax rate was 20%, for state and federal local taxes or whatever, FICA is not exempt, but you know, I would have a deferral of the 2,000. I was going to say deduction, but it's more of a deferral.
Right.
So it's pre-taxed on the contribution. Now on the Roth, you're going to go ahead and pay that tax. But the growth, see, the bigger part of your 401k is probably not going to be your contribution over 20 years. It's going to be the growth. Okay? So on the Roth, we forego the pre-tax status, but all of our gains going forward, we don't have to pay taxes on those. Right.
They're actually yours.
That would be my recommendation for most people. Now, the employer's match is going to be taxable. So if we roll that out into an IRA, you'll have two. You'll have one where it'll be taxable. You have one that's pre-tax, like the Roth. So we have one Roth and one with the employer's part.
Yeah, which makes sense. You're still going to take advantage of the free money. That we'll worry about the taxes later. But at least on what you can control, you're going to pay taxes now.
Yeah, that'll be the bigger part.
That's the bigger part, of course. Okay, lots more to cover. When we come back from break, we're going to talk about rollovers, whether or not to leave that 401k money, keep it there, move it over. We're going to find out next. Phil,
All right.
We'll be right back. On Lowcountry Money Talk. If you're 55 or older, we're so glad to see you. Hey, we're glad to see you no matter where you are in your retirement journey, because we're walking through some of the mistakes that can be made. And we're talking IRAs. We're going to talk right now with Phil about mistake number 1. We're going to start moving through these mistakes.
We'll go through 10.
We got it. Okay.
Right.
So failing to roll over your IRA, what's the problem here?
Okay, so I have a 401k that I've been invested in all these years, or maybe I've had 4 or 5 jobs and I have 4 or 5 different 401ks, and in those 401ks I'm going to be limited on what I can invest in based upon what the employer is providing.
Right.
Don't like that. The other thing would be, as I change jobs, maybe I lose track of my last 401k, so I'm not really watching it as much, right?
Yeah.
So I lose kind of count. The market does change, if you haven't noticed.
Boy, does it, yes.
So it's important, you could be missing out on some returns, or, maybe as you retire, maybe you want to take a lower risk profile. So you're not keeping up with the 401ks, or at least a lot of people don't. So that's one thing. Yeah. The other thing is, not just for people that are in the 401k, but if you have a current IRA, and let's say it's with one custodian, and you want to move it to another one, that's also a transfer, so a direct transfer. You want to make sure that's done proper,
right?
Or you can have some tax problems. So let's talk about that. So
okay, so yeah, and what if you try and do it yourself? A lot of people do that, but there's mistakes that can come along with that, and you maybe, like you said, do the wrong method.
Yeah.
So what should we do?
So the first thing, going back just to reiterate, is I want to roll that over to an IRA so I can pick what investments I want, whether it's stocks or exchange traded funds, and maybe my current provider doesn't allow that. Now I'm saying I no longer work at the company, I've retired or I've left.
Right.
So I'm not worried about the matching and such, okay? Or maybe I'm over 60 and I have a huge balance that I can move over now to an IRA, but still make my contributions. Most companies will do that now.
Okay.
So, talk to me, I'll let you know.
You know a few things about this, don't you?
The other thing we'll go into mistake too is it kind of goes along with this. Let's say I decided to do the rollover,
yeah.
Okay? And I just call in and I say, okay, send me a check. Well, there could be some confusion there.
Right.
So you call into your provider and send a check, and you're like, usually they'll ask you the right questions, but these days you never know who you're talking to. So they may withhold taxes, they may not consider it a rollover, all these things could happen in a bad way. And you thought you did it right, then you get a 1099 the next year saying you converted, or you took a distribution from your 401k of $250,000.
Right. Income.
Oh,
we
boy.
want our money.
That's a bad one.
Yeah.
So we usually like to do a direct transfer.
Okay.
So if you're working with a professional, usually they're going to make sure that's done properly, okay? In comparison to, like, people get confused and, maybe somebody's asking you a question you don't understand over the phone, and maybe you do the wrong thing.
Right.
Or maybe they withhold 20% of your 401k when you're transferring over because they think you're taking a withdrawal. So there's all kinds of bad things could happen there.
Okay.
So we don't make sure that we do that right. And also, if you receive the funds, there's like a 60-day rule that you have to get those redeposited. And if you don't, you're in big trouble. And then we could have tax consequences. And if you're trying to do IRA to IRA transfers or all these and you get a check, you got 60 days, you can only do that once a year. So they changed the rules on that a few years back. You can do as many direct transfers you want. Okay. But you can only do one where you get the check and you're doing it yourself and you put it in. You should only get one of those a year. So don't make that mistake. Just call me. We'll talk about it. and that'd be a good time for you to let them know maybe how they get in contact with us.
Yes.
And then in the next segment, we'll pick up with mistake 3, I think.
I think that's a great idea. We have a lot more mistakes to roll through, but if you want someone to take a good look at what's going on with your picture, maybe you have a 401k you're trying to roll over, you can always get a Revolutionary Wealth review. They're going to walk through everything you've got. That has no strings attached. It's totally complimentary, so it's a great way to just check in with where you are. Call Rachel. She'll get you set up if you have $500,000 or more in investable assets. And we have a whole half of a show where we get to talk more about mistakes that can be made. So please stick with us as we unpack those after the break. To Lowcountry Money Talk. I'm here with Phil Bloyd as he walks us through the 10 mistakes, top 10, because there's more than 10 I learned, that you can make with your IRAs. And we're going to roll through some more here.
Let's go.
Our viewers are wondering, this one's interesting because we talk a lot about tax implications on this show, and number 3 is not accounting for tax implications of traditional IRAs.
Right. So we talked about traditional and Roth. That's 2 separate things. So on this one, we're going to talk about most of the people that I'm seeing right now are still in the traditional format of an IRA. So they're not accounting for it. When that dollar comes out, it's taxed as ordinary income.
Yes.
And if you're receiving Social Security, that can be a problem. Medicare, that could be a problem. So one of the big mistakes is people don't consider, hey, when I take this out, it's just like I was working again, it's ordinary income.
Right.
And, it might take them a tax return or 2 to kind of figure that out. So we always want to look at that tax return. We want to look at the distributions from the IRAs and how that's going to affect you. Okay. So that's number 3.
And number 4 is talking about converting to a Roth IRA and not considering, this is something that Phil talks a lot about these conversions, not considering the full advantages of making that conversion.
Sure. Well, Jess, we've been doing a lot of those in the last couple of years.
Yeah.
Just because the market part of our investments are down, so maybe it's a good time to convert them over before they go back up. But we do it a little differently. We look at when a stock moves up, we kind of look at the day before value and convert over at that. So we can really be almost like a surgeon, just pinpoint on how we're doing our conversions. Most people I know, most advisors, they don't take that, that surgical approach to conversions. They're just kind of shotgunning it, wide target. And I'm like, I like to hone in on that.
Your strategies are just so incredible.
Look at the advantages of converting from traditional IRA to Roth now. Compare it to your tax brackets. We're in lower brackets through tax year 2025. We always talk about that. So you've got a couple of really good things going your way for conversions right now. 1, the equities part of your portfolio is probably down. 2, you've got lower taxes for this tax year, 2024 and 2025. So mistake 4, make sure you get a plan. Don't wait too long.
That's right. God, we could do a whole episode on that on that topic right there, because it's so interesting how now is such a good time to make those conversions. A big takeaway I've learned from you, Phil. And then there's the timing of it, right? And that's really what I was just talking about. Is now is a good time.
Yeah, we talked about the timing. So most people be careful. It's like, well, I want to do a Roth conversion. Well, I've got $250,000 in my IRA, I'll just convert it over. Would you like to pay an extra $250,000 taxable this year?
No.
Probably not. So you want to break that down into smaller bite sizes. What I typically do is I'll get a target from a client. A client might say, this year my target is to convert over $50,000 taxable. And I'm like, okay, let's look at your tax return to make sure that's okay and we're all good with it.
Right.
How much we're gonna pay in taxes. Where are the tax dollars coming from to pay the taxes? I prefer them to be outside of the IRA, okay? It's more efficient that way.
Yeah.
So then we have this all locked down and the target's 50. Then I'll dial down and say, okay, this stock here, there's 8,000 in it. It went up this morning by 10%. So we're going to convert it and get yesterday's price for taxes. So I'll pinpoint even further, knowing that I have a target for 50 that year. So over the course of the year, depending on what stocks we hold, I'll decide which ones we want to convert over to hit that 50.
It's like chess. I can just see you in the office there. I love
You
it.
want to be precise. You don't want to just shotgun this, because the value of those stocks 10 years from now, I had one guy come in, he's like, well, you know, this one actually went back down. I said, yeah, they can go back down, but you're in retirement, we're looking at 10-year spans. We're not looking at 10 minutes or 1 year, okay?
That's right.
Long term.
When we come back from break, I'm going to leave us a little time on our next segment, cushion this one, because using the wrong investment strategy for the distribution phase is mistake number 6. I feel like we're going to want to talk about that for a little while when we come back here on Lowcountry Money Talk. Lowcountry Money Talk. Phil Bloyd with Revolutionary Financial Group is walking us through the top 10 mistakes that you can make with your IRA. Good thing.
Yes.
Because there's a lot.
Let's not make them.
Don't make them. Okay,
Let's
number
learn.
6 is using the wrong investment strategy for the distribution phase. I feel like this is one that could go really wonky.
Yes. We beat on this every show almost.
Yeah.
We talk about the bull bear IRA strategy. So simply, when we're in a bull market, we would like to take the withdrawals from the increasing value of our equity performance. When we're in a bear market, we want to leave the equities alone, because typically in a bear market, the equities are in decline. So we need to take the income. We need to switch our income from coming out of the assets that are based more in a low risk, where they're not fluctuating as much, and that's the better way to go. So I just see people every day. Saw one yesterday, they're doing it the exact opposite. And what happens when the market recovers, you've been taking too much out of the bull, so the bull is in decline, and then you're taking more out of it
as it's down.
So when it comes back, it's not going to come back as much.
Well, and the importance of just having somebody just kind of looking at that and saying, this isn't making sense.
Yeah.
We need a strategy that is different from this. Number 7, and a lot of folks probably going, whoops, yeah, I should check that, outdated beneficiary designations.
Make sure your beneficiaries are correct. Remember, with IRAs, there's tax implications. So we would prefer a named beneficiary at all possible. I understand we have some complex, we have multi-families, step kids and this and that, so that could be more complicated. But if not, we want a named beneficiary, preferably spouse, children, whatever, and then they can make their own tax decisions when they receive the inheritance. What you would hate to do is to lose value because you have your beneficiary designations incorrect, or you change maybe one CD renewed from another and you didn't get your beneficiaries moved over to the new one. I've seen that happen. More recently, you may have your 401k providers may have changed through your employer, and you didn't get your beneficiaries on your new provider.
Such an easy thing to have happen that you just probably wouldn't even necessarily notice. You think it's all good. Along those same lines, of course, if it does wind up going to an inherited person, maybe you're inheriting, not considering the tax impact of that.
Yeah. So remember, if we pass away, we have an IRA as a spouse, they typically take it over. The distributions the following the year of death will be based upon their age, and so on and so forth. No really huge deal there. When it goes to non-spouse beneficiaries, then there's some issues as far as taxes. So we want to make sure that we understand that, and please call and I'll go through that with you. But there's been some changes recently with the Secure Act 2.0.
2.0.
So,
well, that's the thing. Things are just constantly changing. So it's really hard to keep up with unless you have a professional navigating all of this for you. And then, of course, we need to talk about number 9 is potential negative impacts of required minimum distributions. And this can get a lot of people, in retirement.
Yeah, there's a penalty. We don't like that word, penalty. So again, with the Secure Act 2.0, if I was born 1951, 1959, or whatever prior to that, my required minimum distribution age is 73. So I have to take distributions the year following, by April 1st following my 73rd birthday. There's some issues with that too. I'll get into that maybe another show or something. But just remember 73 for the most part, because a lot of people still think it's 72. It changed to 73. And if I was born later than 1960, it's actually going to be age 75 for minimum distribution until they change that.
Oh my goodness. Okay, lots to keep track of.
Okay.
Another one as we just about close out the show here, and we'll tell you how to have this all taken a good look at if this sounds a little bit daunting or maybe like a mistake you're making. But here's something that I've learned from you, Phil. You don't just need a retirement plan, you also need a tax plan.
Yes.
And mistake number 10 is not engaging in tax
Sure.
planning.
Well, the IRA, the traditional IRA, is a tax trap.
Yes.
Okay. So if you don't do tax planning, you know, you're going to be in for a big shock when you start taking distributions.
Yes.
So that's going to be more of a complex issue on an individual basis. But just remember, the 401k and any pre-tax is a tax trap. So you have to be very careful.
Absolutely. And the
Make
good
a
news
plan.
is you can plan, and you can plan with the help of the professionals. Revolutionary Financial Group does a revolutionary wealth review, and you bring everything in, you have them really just take a look at everything that you have going on. They'll find you great ways to save money, make more, save more, and just have a better retirement picture.
Right.
I think it's really important.
And avoid these mistakes.
Just avoid these, especially the top 10 now that we've told you about them. All right, call Rachel if you want to set that up. Please join us for our next episode of Lowcountry Money Talk. It's been so nice to see you. Thanks, Phil.
Mm-hmm.